It's month end. It's also quarter end. We've also got options expiring. That means maybe we should be braced for a little volatility, or maybe the opposite. Cem Karsan is here to walk us through the situation. Who better to have on days like this? He's a senior managing partner at Volatility Advisors. Cem, welcome back to the show. Thanks for being here. What are you looking at today, and what should we be ready for here? And you're not allowed to use emojis.
Thanks, Oliver. Thanks for having me. Yeah, no emojis today. Actually, fortuitous timing for this interview. Actually, just as we were sitting here, one of the biggest trades in index options just went up in the last 5 minutes. There's a big trade from JP Morgan's hedge equity fund that they put up every end of quarter. And it's a quarterly put spread collar. So they buy put spreads, sell calls, premium neutral. SEP quarterly 34 quarter, 40-60 put spread versus the 44-20 calls just went up 44,600 times. That's SPX size, so 446,000 spider size, just to give people a sense that are more used to looking at those things. It's a massive trade. For about a month now, it's been having dramatic effects. Really, last 2-3 weeks in particular, it's been leading to incredible compression. A lot of the pinning of the S&P that you've been seeing and the rotation around it and other indexes has really been driven by not just this, several other trades, but this is a major component of that. And so now that that's come through, that kind of represents an important kind of turning point. Vol is dramatically oversupplied in the indexes. Like I said, we've been calling for this kind of market pinning and this vol compression we've seen for about a month. And have been spot on. We've been calling for that to keep going till July 12th at the minimum. We feel like coming July 12th is a time for caution. I know it's a very specific date. Why July 12th? Until the 4th of July holiday here, you have a lot of very cheap gamma in front of the holiday. And then the week following that, you get a lot of beginning of quarter flows, which are very, very positive, with new money allocation coming in A and B. Also, you get into that week before OPEX, which is generally the most bullish due to index kind of Vana and charm flows. I've talked about that on here before, but essentially dealers are short put, long call, and risk reversals, similar because of this trade, among many other trades, right, where the street is hedging, and they have to buy back their short stock over time as you go into expiration, particularly that week before OPEX, really accelerates. So that's a very bullish supportive time as well, given the vol supply. Be a very challenging time for this market to unpin. More likely than not, come July 12th, which is that beginning of that OPEX week, going into a 5-week OPEX cycle. You have a lot less Vana and charm support, a lot less other support. Vol is at its nadir. It's the lowest it's been in a year and a half now since the March 2020 debacle. And so we're really poised for potential energy for some unpinning when that happens. And again, I'd start to be very cautious as we get into the back half of the year. A lot more kind of bearish things coming up the pipe fundamentally, that once these kind of vol dynamics that have been pinning us in the summer really start to release, could start to be more of a concern.
Okay. So that's second half. I want to get to that second half because that's when things in your analysis turn a little bit more macro. Right now in the short term, not to put you on the spot for like an intraday call, but that's kind of what you do, Jim, online. I mean, now that we got this big trade through on that fund that you mentioned from JP Morgan, is the morning kind of downside that we got, that 0.25% slip at the open? I mean, does this have real function in the market to provide some buoyancy for the rest of the day?
It's really going to compress vol. So everybody's always asking me for a direction, but sometimes the direction is compression of vol, right? Okay. Sometimes the direction is pinning. So I think the most likely scenario here for today is really more of this pinning action that we're seeing. We're butting up against a 2 standard deviation of the 20-day, which technically is a kind of resistance level. There is some chase and more likeliness to creep up as these Vana and charm flows continue every day. There's a little bit of buyback that's added to that. Pair that with, again, like I said, tomorrow's beginning of month flows, as well as kind of some of the end of quarter window dressing. So I think it's supported today. I wouldn't bet on a big rally of any kind today. But that said, I think vol compression is the name of the game until July 12th, and I would continue to play that. I think an important point here is, even though you have that support that I'm talking about technically in terms of these flows, you do have the Fed taper, which is essentially the Fed writing calls, right? The Fed is, if the economy increases and the market continues to rally coming into the fall, they are going to taper. That's kind of the opposite of a Fed put, right?
Right.
If the market declines, the Fed put is essentially they're going to provide liquidity. Well, they're going to be removing liquidity away, the more likely we are to rally. So that fundamentally adds resistance to the markets, adds less likelihood of upside volatility, that's a counterweight to some of these more technical structural flows that I'm talking about. So I think the market will have, will do relatively well, continue to tick up till July 12th, but I would expect it to be very placidly. If anything, kind of more pinned to slowly up, nothing.
Okay.
But that's an opportunity itself, right? Selling volatility, even at these low levels, is a profitable endeavor, and particularly, they're on the call side.
So you think we could go VIX even lower than 14?
Not necessarily. I would look at more calendar spreads.
Okay.
So I'd be looking to buy. I think we're hitting closer to a floor here in the back. So I would be looking to own, 30-day to 60-day vol and be short really this July 12th on forward and collect decay and really benefit from the pinned realized volatility that we're experiencing, less a bet on the implied volatility itself.
Okay. So, Cem, looking at this event that we've got also on Friday, is we do have this employment report. We heard an argument yesterday that getting some exposure to a hedge to the downside, given the big move in VIX downwards, that's a position that makes sense. Is that a view that you hold? It seems like you would say it's not really worth right now trying to buy downside protection. It seems like, as you mentioned, kind of using volatility to advantage through calendars is a different approach. Does the employment report on Friday have any potential to jostle some of the stickiness of the levels that you're talking about technically?
I think the supply of vol is so great at this juncture that it's going to be very difficult for the market to move. That said, I've been very vocal about this for quite some time. Distributions and expected distributions of the market are very fat tail at this moment. Fragility on the tail. When you're in a situation where there's massive leverage in the system, what that does is that pins volatility locally. So it's very hard to move. But when you do, there's not enough liquidity in the system to absorb the amount of leverage on the tail that exists. So we're definitely in a fat tail environment. You want to be long convexity and tails. Skew is very high right now, but based on our analysis, it's actually cheap relative to the potential outcomes. I'd much rather be short local vol, at the money, closer in time, and long some of this convexity in the portfolio.
You mentioned skew. One of the things that's, I think, interesting there, that we're so far above where we were in the COVID period. Actually, we were higher in 2018 coming into a rate hiking regime. Is that a coincidence, to kind of come back to your second half of your points about the macro side and the Fed switching? Because I've heard the Fed kind of switching from being a Fed put to perhaps a Fed call. Cem, I continue to hear frameworks that were pre-FOMC. They haven't changed at all post-FOMC. It's bothering me because it seems like the Fed did give us something a little bit different here. Should we be operating under a little bit of a different framework?
Yeah, look, fundamentally, the issues are there, not just in terms of what the Fed is doing. That's the key to liquidity long-term. Ignoring that would be folly. But not to mention positioning, hedge fund positionings in the 99th percentile. Retail positioning is similar. There's so many warning signs out there, and the problem is structurally, people are aware of these. People are aggressively writing calls because it's incredibly profitable, and they are buying skews. So people are hedged, and I talk about this with my kind of Gary reference. When people are hedged, the dealer positioning has to be respected. There are massive feedback loops that that drive market effects. But you have to kind of pick your points, look for the windows to for these fundamentals to be able to take over. And that's why a lot of times there's a delay. If you look at the COVID response, I think it's a great example, right? I mean, we knew about COVID starting in late December, early January. Everybody was talking about it. It took till mid-Feb and at the end of an expiration cycle, really, for things to take hold, and it ended exactly on the last day of the March quarterly expiration cycle. These flows are critically important to for actions to begin and to kind of unroll some of the pinning and the effects that these things have.
Okay, so your point is, with these major players at work in the market, the most likely outcome is we remain pinned towards these particular strikes. But if there is breakage from that with some of these other macro risks that you're talking about positioning-wise, the move could be fast if we do get away from those areas. But your macro view is that the odds that we get away from those areas increases later on in the year after the dates you've highlighted for us. Is that a fair summarization of our conversation?
That's a great summary, Oliver.
All right. Great to have you back. Cem Karsan, thanks. Always got to make sure we got it. All right. Appreciate it. Thank you. Joining us from Volatility Advisors.